Welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. And today we are going to be talking about Dropbox. I'm going to be asking Fabio some questions about the stock. I've indicated in the past that I am potentially interested in investing in this stock. So I'm just going to be asking a couple quick questions, just some things that might be on my mind as well as the audience's mind. And then by the end of this video, we'll decide if it goes on to the next phase of my evaluation process if I choose to invest.
You say phage?
Phage? Did I say phage? It must be so late then. I meant stage, but phage.
and for those of you who may notice, my audio is no longer going to ear rape you.
Yes, we fixed his audio.
His drivers installed.
Yes, he didn't have his audio drivers, so we had to, just tweak a little some stuff, and now he's all set to go. So
I'm not the audio expert, so I have no idea.
All right. So what are we looking at here today?
Well, wouldn't you like to know? So basically, we're looking at Dropbox. So as always, we're going to show first the share price movement, kind of talk about the business, what it does. And so again, we're going to kill two birds with one stone here. Austin is very curious about it for his own portfolio, whether or not he's curious going forward. He's going to decide that today. And then we also got some subscriber requests. As always, we do this for you guys. If you guys have any requests, drop them down in the comments, or you can submit it through our website. All right. So
capitalmindset.org, capitalmindset.org. So
perfect. And
yes. To start here, Fabio, what were some of the reasons for this most recent price drop?
So it could be for a variety of reasons. At the end of the day, we don't actually know the precise reason. We can only make estimations or guesses as to why. And if I had to kind of guess, it has something or a mixture of the following. It could be the loss of momentum from the work from home play. So Dropbox is part of the work from home stocks. And it could also be for the reason that, the whole index, right? There's a bunch of indexes, right? So everything is ETF-ized. We might do a video about that in the future, but in brief, what that basically means is everything's kind of put into baskets now, and Dropbox is no exception. And so a lot of things that follow a certain theme trade together, and sometimes they may unfairly do so. So Dropbox could be trading down from that. And another reason, either of these you could ascribe to this, and you get to choose as the viewer what you think it is. But another reason could be that interest rates, right? The threat of interest rates rising does impact future valuations of assets. So things that are considered to be assets that will have value in the future based on revenue growth. That could be the case. Now, before you say that, you might say, okay, well, Dropbox isn't really growing revenues that much. However, it does fit under the software bucket. And again, when things are put into buckets, they tend to behave together because the financial world is ETF-ized, and I made up that word. It's just
okay. So now I kind of have a question. You just indicated there that with revenues, even though Dropbox is not growing its revenues, is what you're saying that's typically like very, very smallly, but is what you're saying is that's typically indicative in software industries themselves or software businesses themselves? Is that the point you were trying to get across, just so I can understand?
Yeah, it's that the software industry as a whole tends to be ascribed that characteristic that they're high revenue growth, so not very profitable in the short term. And that when you actually use mathematical models to kind of discount the future cash flows, right? The higher the interest rates rise, the lower the value of those future cash flows will be. So it actually puts more emphasis on cash flows in the present. So present values, not future values. So future values actually get hampered, right? And so something like Dropbox, we'll go over that, but it's basically probably not that applicable to it. So again, that's why I presented multiple theories, and then you get to decide which one do you think it's possible. But the answer is we don't actually know why. Sometimes we do. For example, Activision, when we talked about that, it's the scandals going on, the sentiment. The sentiment has obviously gotten worse. But something like Dropbox, it's not necessarily the sentiment. The CEO is not caught up in a scandal or anything like that. It's kind of like the general move down. And then we can see that the volatility is greater than the broader market.
Okay. So, yep. Yeah.
Well, I mean, before we go on, do you have any questions about?
I was about to advance forward and just start to ask
Yeah.
questions specific to Dropbox themselves.
All right.
So Dropbox themselves, that's kind of funny. But just to start,
Yeah.
basically three basic questions. What is Dropbox, first and
Mhm.
foremost? What does Dropbox do?
Yep.
Like, what are they selling? What are they offering that distinguishes them from competitors?
Yeah.
Third is who are the customers of Dropbox? Who
Okay.
is Dropbox tailored to? So
So I'll try to answer all those at the same time. But Dropbox basically is a cloud storage platform, and in the case of Dropbox, they have many different plans, but primarily the customers are the users, right? And so I'll kind of go over real quick over here. So this is one of their services that they offer, and pretty much it flies from personal to business uh, clients, and then personal clients you have plus and family. And so the plus is the cheapest variation of their services, and they have the prices down here below. It's $9.99 a month. So what you get with that is about 2 terabytes of data, plus a bunch of other little features that you can kind of go over here. But it's pretty bare bones compared to the business part. And then in the family part, you get 6 users. So the difference is you can have different logins. To be honest, I actually have a little bit of a gripe with that. So if you're giving it for family, you're paying a little bit more. Um, Unless I misunderstand this, because I actually don't use their family product. So unless that means 2 terabytes per user, then that's something else. But you see, you're
okay.
paying about
I would
$17
I
per
would
month.
probably assume that's what that means. Another question that I have now. Okay, so
Mhm.
my mind is now oriented towards, because you indicated that there's both a paid and a free version. What distinguishes the free version from the paid version? In this case, it's
Yeah,
probably data. You get more data. You
data and
also in
services.
you also indicated too that there's features that come along with these. What are some of these features? And then what distinguishes the features that Dropbox offers from the features, let's say, Google might offer?
So that's actually where the features don't really distinguish themselves. So that's where the argument comes in that it's commoditized. And that part may be true, right? So this specific part, but that's not actually looking at the broader picture, because if you focus and hamper down on the cloud storage, then you're correct. But like, so for example, we have competitors like Box. We have obviously Google Drive, right? And the Google Drive, it has the free version, which is 15 gigabytes, and Dropbox, the free version has 2 gigabytes. So you might just look at that on the surface and say, well, Google's clearly better and it's free, right? But then we're ignoring all the other things that Dropbox is kind of piling in together. So
Yeah.
Dropbox is trying to push for what we call the workflow optimization workflow. So, or workflow optimization. So it's trying to be that all-in-one service, or at least provide many aspects of that service that helps businesses make workflow more efficient.
Okay, so some of those aspects I would probably assume then, because Google, which I would assume is a key competitor of Dropbox, which they're, Google's cloud storage, I would probably assume then that there's at least, or I would like to see at least an initiative from Dropbox that allows people in the same team, in the same workplace, to collaborate on various files together. My other question for you too is sort of, why should I, as a consumer, choose Dropbox? That's how I like to approach these sorts of businesses before I decide if I'm going to invest in this or
Um,
not. Why should I choose Dropbox?
so
You know?
a lot of the users, the personal users for Dropbox, they are typically freelancers, and Dropbox has this ecosystem where you can actually sell your, or they call it, I think, Dropbox Marketplace, where you basically are allowed, or it enables you to easily sell the products you have. For example, let's say you're a photographer, you can easily monetize photos, right, through Dropbox. They make it very easy. And same with video content. So it's things that Google just doesn't have right now, because Google has
Mhm.
so more, they have bigger things to fix. Google's
Okay,
heavily
so
focused on the cloud itself, cloud infrastructure. They don't
now
really want to focus on this tiny piece.
my question is, that's wonderful, and I'm glad to hear that, especially in regards to the freelancers. However, do they have patents on this respective different types of technologies? Like, what stops a competitor from coming in and just doing the same thing that Dropbox is doing now in regards to this?
So in broad speaking, like the certain things like, okay, storage. They don't have a patent to storage, but they can have a patent on UI, on so UI, so user interface, making
Hmm.
theirs easier to use. And UI is very important. For example,
It is.
I have
Yeah.
a ton of people that I know that just outright prefer Robinhood. And I tell them, okay, let's move on to more serious broker. And they just want to stick to Robinhood because of the UI. Robinhood, I'll be the first one to say, has one of the best UIs for brokerage. It's so easy, so seamless. It may not have the best execution, but that's, the UI is amazing. It's so simple. And then it's
Hmm.
seeming like, for example, Chase You Invest. You have obviously a larger bank behind you, better customer service, arguably, and the UI is terrible, absolutely terrible. I don't know if you're familiar with their product, but it's terrible. I mean, I'm
Mm.
picking on like the worst one, but it's an example of why UI is pretty important. So we don't want to discount that. And then they
Yeah.
also have been acquiring companies such as HelloSign, DocSend, and they've been trying to monetize these as extra ancillary services that they can offer. And then on top of that, they're trying to build a in-house workflow platform, kind of like Slack. And there's an interesting story to Slack. So Drew Houston,
Um, Before you go to that, I have a question
yeah,
about the companies that they're acquiring.
yeah.
You indicated that they're trying to find some way to monetize these. Is there a strategy that they have in place that the CEO is currently executing on by which they are monetizing exactly these companies that they've acquired?
So basically, the whole idea behind this is it's platform agnostic. So what that essentially means, agnostic, means that you can use any other platform and kind of combine, mix and match services. So in the software industry, if
That makes sense to me, which
yeah,
is why if you go onto Dropbox's home web page, they have that they're partnered with Adobe,
yeah,
Zoom, Google, all these other companies, and because they are in that instance platform agnostic, would you kind of expand on that? I know that you were about to before I rudely interrupted, so I'm very
no, no,
sorry
you're
for
good.
that.
No, no,
But
you're good.
would you kind of expand on what the concept of platform agnostic means, and then also why that is so important to the software industry?
Well, within the software industry, so like let's say I'm representing a company, right? And we
Mhm.
want to get a suite of software products to help us do our business better. Normally, what we're going to do, or not normally, what we will do is pick the best of breed. Best of breed simply means, and specifically what they do, they are the best. So let's say there's two companies, for example. One is really good at email security. The other one's good at endpoint security. Endpoint, when I mean by endpoint, so I define that correctly, so everyone understands what I mean. Like let's say cell phones of our employees. Okay, so they're really good at that, but they also offer email protection. So what I'll do is I'll take the best email protector, right? And then I'll take the best endpoint protector. And then what will sometimes happen that's not good is if, let's say, that endpoint protection security company is not that good in emails at all, but they're really good at endpoint. But then they say, if you want our endpoint, you also have to take our email. That might actually hurt their growth, because then I'll look at them and say, well, I don't really want their email because my email is important to me. So I'm going to use this company, and then I'll use the second best of the endpoint if it's not that far away, right? So you
Mhm.
have to have a really compelling product in order to kind of have that leverage or power. But
Okay,
most software
so
companies are platform agnostic because there's so much software out there. You can't just be like, oh, you have to use all of our products.
almost what I'm sort of seeing here is a risk diversification here of
Yeah.
sorts.
Mm-hmm.
So this almost kind of, at least where my mind would go, is that this is almost a staple point for what I would like to see in particular software companies. I would like to see them being platform agnostic, unless what they, or actually both. I would like to see both platform, that they're both platform agnostic, and then also that they might have a software by which they execute really, really well and that they can
Yeah.
sell to these
And
various
you
companies.
you can still
Interesting.
think of it like Dropbox is integrating all these different services and saying, okay, so if you use Dropbox, you'll get access to cloud data storage. You can have HelloSign, you can have DocSend, and then you can have eventually, I don't know when it's going to be out. It might actually already be out and testing the workflow program. So then you can have all these things all under Dropbox, right? And then all
Um,
Dropbox really needs is
yeah, no, go. Sorry.
no, all Dropbox really needs is to figure out a way to actually then have video conference like this, because
Hmm.
that's, if you want to be honest, that's very commoditized.
Oh yeah.
So we can talk about Zoom, but these other businesses, I actually always thought that Salesforce would have bought them, but I think that Drew Houston is more ambitious than that, and I bet you he didn't want to, because Salesforce used to own a big piece of Dropbox. They sold out because I assumed that what happened was they knew they couldn't buy out the whole thing. I don't think Drew Houston wanted to sell.
Yeah.
That's just my theory.
I think I actually remember hearing something about that, that he was not willing to sell
Yeah,
a good portion of his business. Okay, so now I have a couple questions before we
go
move on
for
to
it.
Drew Houston and just a little bit of some of his CEO strategy. You mentioned earlier that Dropbox is currently trying to build its own version of Slack. Well, what is Slack? What does that mean to the investor coming into this and looking into this for the first time?
Specifically, they're trying to build their own workflow solution program. So Slack is basically where, like Microsoft Teams, like we come on together and then we can work on a project together in whatever industry we're really working. But it's kind of like Discord in some ways, but
Yeah.
it's focused on workflow. And then so Dropbox is trying to build something like that. But however, remember they're platform agnostic, so you can still use Slack and still use Dropbox. They're not going to say you can't integrate yourself with Slack. You have to use our service. They're
Okay,
platform agnostic.
so now my
Mhm.
my question here is what
Yeah.
why is Dropbox even building this? How, like, what are they building that is better than what is currently on the market now? And
Well,
then also, yeah,
we won't know that until we see it. So basically, again, with that kind of stuff, it has to come down to user experience. It has to be easy to use.
yeah,
If
some
it's not,
UI again.
yes,
Yeah.
UI is extremely important. It's not necessarily that it has to be, game changing, proprietary technology that no one else can copy. What people can't copy is the UI. And if the UI is fantastic and it's better than what's out there, easier for someone to just pick up and just start working with it, then that's what's going to ultimately win in the end. And if on top of that they can sweeten the deal by offering all these other services, like again HelloSign and DocSend and then Dropbox cloud storage, this can over time increase that ARPU, which is very important.
ARPU?
ARPU, yes,
What is
average revenue per user. Yep.
okay.
So that's a very important metric we want to keep track of. So
Hmm.
ARPU, and I'll actually go over to show everyone this from the shareholder presentation. And right here, we can see that the registered users is over 700 million. That's actually been still growing, which is insane. And
Wow,
then I don't
that's
really
pretty
care about
incredible.
the pieces of content because they can't really monetize that per se,
Yeah.
except through what, remember what I told you, Dropbox Marketplace. So we don't know how much of that content is actually being monetized through the marketplace, which I'm sure they get a small cut. And then you can see here again, paying users 16.49 million and 80% are used for work because that's what their whole thing is. It's not really meant so that, remember going back to this, if you think to yourself, I don't really use Dropbox, well, they're not really catering it to you per se. If you subscribe and you're just some person trying to, you know, get storage, that's not their customer. Okay. Their
Okay,
customer.
so yes, yeah, their customers are typically businesses. So if I'm getting this right, what I'm understanding about Dropbox right now is that they offer
Mhm,
different features. They offer more data through their products. They're mainly catered to businesses. And the vision of the company at the current moment is they want to streamline a lot of the workflow process.
correct.
Okay.
Correct.
So that's well and great. I understand that portion of Dropbox now. Now let's kind of move on to the CEO. How well is the CEO executing this vision? And then also, is he facing any resistance politically from the board, et cetera, so forth, from his own management team, from employees? You know, are there is he executing this vision correctly? And then are there roadblocks that might prevent him from executing this if he's not?
Yeah, so I guess the board is the roadblock because in the past the board had stopped them from, proceeding in this direction. And for example, the biggest example I can really point to is their denial for the acquisition of Slack. So before Slack is now being sold to Salesforce, Drew Houston actually wanted to purchase Slack. And
Mhm.
now in hindsight, that was an amazing decision if he could have done it. Of course, you might say, well, would have the same scenarios played out, if we change things out, because butterfly effect. But let's assume that they would be similar. It was an amazing opportunity that they missed out on, and that was because of the board. Now,
Okay, so now my question is, why did the board decide to say no in this instance here?
the risks. They thought it was too risky, and the board of
Okay.
directors is supposed to be kind of an advocate for the shareholders. That's what their job is. They're supposed to
Okay,
be the
so
representatives.
the purpose of the board of directors is that they
Mhm.
are supposed to exist as advocate for shareholders,
Correct.
by which management answers to. Okay,
Correct.
cool. So a little nugget of knowledge for maybe some of you newer investors. The purpose of the board of directors is they're supposed to be advocates for shareholders.
Yes.
So perfect.
And in this case, they were not a good advocate, because they really misjudged this. This is a big deal. So now they're more trusting of Drew Houston, and they have allowed him to kind of push his vision about what Dropbox can be. And I think that
Hmm.
that's appropriate. And I think, for example, Drew Houston, he's on the board of directors of Facebook. And so he has that job itself, but for Facebook. So he's always going to be privy to what Facebook's doing. And I think that's very important, because if you think about the metaverse and what Facebook could potentially accomplish, Dropbox has a good opportunity to pivot and profit from that in many different ways. And I think they're already starting to do that. Because
Okay, so that's now a really, really interesting point, is that they could be potentially a major player in sort of the metaverse play. However, is the business, and I would assume yes, at least looking at this, is the
Mhm.
business still primed to succeed if the metaverse does not go through? Is there like a fallback plan for this business?
So if the metaverse doesn't go through, and their ventures with the metaverse don't pull through fully, then I do
Hmm.
think there is still a possibility for them to succeed. It's, again, focusing on the niche, which is the workplace environment, work optimization. And I'll kind of show that here because they outlined it. You might have already seen it when I pulled it up, but it's team collaboration, content management. So smart workplace, right? They wanna focus on this. And if they execute on this, and they can offer all these product suites over time, this, I think, is where the world is going to be moving in a lot of the white collar jobs, right?
Yeah.
So it just depends. And here you can see the different products, right? So HelloSign, DocSend, and then to be determined going forward what else they acquire. And if Drew Houston is good at making those acquisitions and keeping that vision alive, then this could become even more interesting going forward.
I now have another question. Is there any indication of Drew Houston potentially making more acquisitions? Has he expressed interest in potentially acquiring more companies going forward?
Yep.
And then
Yep.
also, what might those companies be? And
Anything that has to do with the smart workplace environment. That's the direction he says this company's going, and
okay,
that's where they're gonna keep going. So
okay,
anything that he sees can derive kind of accretive revenues to the business, and that focal point of smart workplaces is what he's going to be going after. If it's
okay.
some other business that has nothing to do with that, he's not going to buy that.
So now I understand the business. I understand the CEO's vision, and I also understand potentially some roadblocks with the board that seem to have been alleviated. Now let's kind of discuss something else, and this is the competitors. How are
Mhm.
competitors of Dropbox responding to the initiatives that Dropbox is taking to become basically that number one company in within its respective space?
All right. So we have a couple of competitors. I mean, depends on how direct you consider them competitors, but I think the
Mhm.
most closest competitor is Box. Not actually Google. Google doesn't really go after this too much because they're focused on, again, on cloud infrastructure. They go after
Yeah,
it in a rudimentary way, like
yeah, it's sort of
software.
just like a here, like take it, like
Yeah,
whatever.
yeah. They
Yeah.
just have some competitive offers for the personal use, and they I'd say Box is the biggest competitor to Dropbox in this category, uh, mainly because they're pretty much almost the same thing, except Dropbox has a bunch of ancillary services that Box doesn't offer yet. But Box focuses on the enterprise strategy, which basically means they try to get the big contracts for like companies, and then the workers will use it. While Dropbox is kind of like more splinter cell strategy. They're a bottom-up approach versus a top-down approach. So the
Okay, so
workers will adopt Dropbox, and then the enterprise may adopt Dropbox.
okay, now that's very interesting because to me, I was about to ask if Box is at all disrupting the path that Dropbox is currently taking, and then also how is Dropbox responding to this? Because the enterprise strategy, it sounds well and good, but if it doesn't work, the employees are not going to use it.
Yeah,
So it almost kind of
it's
seems like the splinter cell approach, although it sounds worse off in theory because you're not securing the big contracts. It almost seems like that might be the most effective because
well,
even
they
though
are.
Dropbox doesn't, yeah,
They
okay,
are they are securing the big contracts. No, they are securing the big contracts.
yeah,
But the strategy, the way they approach it is different. So it's the focal point. So the focal point of Dropbox is splinter cell approach. And then employees will use Dropbox, and then if many of them start to use it, it becomes like customary, like spreads. It spreads more. Box doesn't do it like that. Box will have to, or the way they do it, the strategy they do it, is they employ a large Salesforce team, and then they acquire large enterprise customers, where it be companies, universities, etc. And then through that, then the workers will use the product. But Dropbox
okay,
does have enterprise clients.
yeah, and that makes perfect sense to me why Box has to use that strategy, especially because it's almost as if the splinter cell strategy is it's like you just
Dangerous
kind of
for
like
them.
plant the
Mhm.
seed and then the seed
Exactly.
grows into this massive tree. So
Exactly.
Box has to take that initiative to secure those big contracts in essence. And now
Hmm.
kind of going back to my other question too,
Yeah.
is Box currently disrupting Dropbox? You shook your head earlier. And then also
Mhm.
too, do you potentially see a time horizon where Box may be able to disrupt Dropbox? Let's say if an element of Dropbox's business were to go down, or if Dropbox were not able to, really execute on their strategy well, or if the board, blocks Drew Houston again.
Well, I mean,
So
all of those things are just true. You basically stated every way in which Box can take the upper hand. If execution,
yeah.
isn't good on Dropbox's side. So this is a company that you do have to probably require some sort of um, extra discount.
Yeah, so
So
a higher margin of safety in the sense. That's
yes.
that's that's where my mind is going with this. There's a lot of uncertainties.
Hmm.
I like the business. There's just a lot of uncertainties for me. So okay,
Let's
I now
take it
have
to
an
the model.
idea. Yeah, of the business, the CEO, a good preliminary idea of the competitors. I'll have to dig a little bit deeper into the competitors. Let's kind of look at it in the model now, and I'll probably ask you some questions about some things that I'm sort of seeing with the model.
All right. And actually, let me make sure that we're telling it this is not a REIT. Good. It's not a REIT. Cool.
Perfect. It's
All
just
right.
going to take a
So
second for it to load.
let's actually go ahead and start plugging in. Let's start first with the 10%. But
Mm-hmm.
again, like I stated, this definitely should require. So let's do the 12% everything money, which I don't think really is often enough because you're applying very little margin of safety.
Yeah.
Um, but
Do you want to just do the capital mindset standard and just plug 15 into it?
yeah,
Might as well.
let's do 15 Dropbox. Okay, so basically what it's saying, if cash flow growth is zero from here, the value should be $15, which is actually quite
Yeah.
compelling because we're not actually that far. And it actually did at one point trade for $15. Now, I think at this point, well, almost 15. At this point, I should actually reveal that I'm actually long Dropbox at 17.80 something, close to $18. Let's call it $18. So I am long this company, but it's set, well, 1780 something, because we'll be precise with the numbers. And I think it's 1783 or 1784.
Mm-hmm.
And I just want to say that because I did say that I was going to mention something about my connection to this company, but um,
So my question is now for some of the newer audience members who might be coming into this video for the first time here. Would you kind of walk us through why you decided to choose the discount rate that you decided to choose for this particular instance here?
well, I actually chose 15 for now. I'll show you what I actually used when I came up with my valuation model.
Mhm.
But 15% is implying, for example, market rate of return plus an extra added margin of safety that I believe is significant enough that you can, for example, make mistakes in your estimations and still kind of come out on top, because that's the idea behind the margin of safety. So how you create a margin of safety is a couple ways. You can do a percentage decrease on the growth rate. So for example, you can imply lower growth, right? Or you can increase your discount rate. So it's kind of math at the end of the day. It's not that difficult. And then you gotta imply the margin of safety at some point in the model. I like to do it through the discount rate. For me, it's pretty
Yeah,
simple.
it just makes it simple that way. Yeah, it makes it
Yeah.
almost easier. Okay, so now that's really really interesting here. So let's keep kind of plugging in some of these growth rates here. I'm sure that maybe some of our audience members are seeing average buybacks over the past years is a negative 25%. To me, that looks like an acquisition. Now, what could be the cause of that right there?
Well, the main reason is the IPO. So they IPO'd, and that's actually causing the drastic change in shares. And it's a big one, so it's averaged out to negative 25%. But
Mhm.
the IPO is the big contributor to that. So it's taking the average, and then so it's making the average elevated. So again, this is why you have to always derive context. If you simply just look at numbers and say, "Oh, now I'm going to be a good investor because I'm looking at the numbers," it's like, no, you got to really get the context behind
You have
what the
to
numbers are.
understand the story behind what the numbers are telling you.
Exactly. We
Okay,
preach that
so
a lot here.
as you're plugging in these growth rates here, after you've entered this final one, I kind of want to move down to the key stats here. I have a couple questions to ask you
Go
about
for it.
this. So we're seeing two classes of stock right now. My immediate question is, are these two classes of stock, is let's say class A or class B, is B convertible to A? And then if so, is the delineation between the two of them just strictly voting rights, or is there an economic interest split between the two of these?
So the model's picking up two classes of shares. Yes, that is true. And no, it would be economic interest is equal. It's just voting rights are different because it's
Okay,
like founder stock.
would you kind of explain economic interest and why that's something you look for when we see two classes of stock?
All right. So basically, economic interest is when you are owed an equal portion relative to what you own. So let's say Austin and I own a stock, right? Or own a company together. And we have class A for Austin, class F for Fabio, right?
Mm-hmm.
Um, and what we can say is, for example, let's say Austin is the founder, right? Austin is the founder, and he has 10 voting rights per stock for A stock he has. And I have one voting right for every stock of F stock I have. So what Austin is getting is greater control of the business. But however, we want to make sure that the economic interest is the same. So one share of his gets, the same amount of profit as mine. And
Mm-hmm.
so that is what we want to pay attention to. If you see different economic interests, sometimes then that starts to get a little sketchy. And then we can get into the realm of VIEs, which are,
I was just about to ask that. I was
yep,
just about to ask if typically in
which are a
VIE
step up from
structures,
that.
you typically tend to see a split of economic interest, which actually we put out a video on Rocket a couple of months back, and that's exactly exemplifying the situation that Fabio and I are kind of walking through now. But now, kind of taking it back to the model here, I'm kind of curious to ask a couple more questions before we move over to the key ratios and then back to the growth rates there again.
All right. What was your specific question?
So it actually had to do with the PE and the book value. I saw that this stock is trading at a negative 72 PE, and then it was a negative book value as well. Would you kind of explain what the implications are of that for maybe some of our audience who may not know what this means in essence?
Okay. So if you took accounting in college or at some point in your life, you may know that price to earnings is price divided by the earnings of the business. But earnings
Earnings
has
per
an
share. Yeah.
asterisk, right?
Yeah.
So the asterisk for this is the GAAP earnings. So GAAP earnings or GAAP accounting has a bunch of different rules that must be applied. And GAAP is decided by who? Who decides GAAP, Austin?
FASB are the
Exactly.
ones who write GAAP. So actually, just as a side note before Fabio continues, you can go onto the FASB website and you can see the changes in accounting principles that will come out. I don't know if it's every year. I'm just going to say for the sake of this that it's every year.
Mhm.
You know, they're always changing GAAP, basically the case in point. But please continue, Fabio.
So if we take a look at the price to free cash flow, which I'll highlight here for everyone, this is where we're looking at. So the PE is negative 72.41. And just by looking at it, you're like, ew, disgusting. I'm going to avoid that. All right. However, if you look at the cash flows, it's a different story. On a cash flow basis, Dropbox is fairly cheap. So Dropbox is trading at 16.62. And with that, we can kind of say, okay, that means they're producing cash. From this cash, right? How can I value that? Okay, so then that's a separate note. That's where we get to the valuation model. And then you
Yeah.
said, were you talking about the book value as well?
Yes, I was talking about a negative book value, but before we move to the book value, why does cash matter in this instance? Because I see a lot of people online just specifically Xing
The forward
stocks off
PE,
PE.
the
Yeah, no,
forward
well, yeah,
PE.
I see that too. But just like I just see a
Uh-huh.
lot of people Xing stocks just based on PE. So why
Right.
is it that cash matters so much to an investor?
Well, cash is the actual money coming in and out of the business, right?
Okay.
The earnings, the GAAP earnings can have a bunch of different costs that aren't actually there, right? They're not actual costs. They're measured, perhaps a little bit differently. And it's their accrual basis of accounting, right? So timing matters and stuff like that. So
Yeah.
smoothing out, over time, the GAAP accounting will match cash flows if you smooth that out over time period. So if people were wondering, okay, well, that makes no sense. Why are we using GAAP? And it's like, no, there's a reason why we use GAAP. And then I go over that in other companies. So everything is with nuance, right? Some companies, I think we've reviewed some that I've said, well, the GAAP is actually a more proper measure. And I think one of them was Interactive Brokers, where
Mm-hmm.
well, not necessarily GAAP, but either IFRS or GAAP, whichever one is applied to the business, is sometimes much more appropriate than the cash flows. And then I think Micron was another one at Intel because
Mm-hmm.
of the ways that the revenues were being recognized. So those are some examples. In
So
this
it's all just
case,
nuance. In
exactly.
this instance, it's nuance based on industry,
Mhm.
based on company, based on
Yep.
circumstance,
Industry,
even.
everything.
So
So
okay.
the cash flows in this business is something I'd be more trusting of. This is what I'd rely on for the model. And the book value, I don't really care about a negative book value because it's a software business. We're not talking about real estate business. We're talking about a software business. They're asset light. I don't expect them to be trading at book value or anywhere close to book value. Return on equity and return on invested capital. These numbers, absolutely, absolutely phenomenal. This is
Mm-hmm.
amazing. Now, return on equity, return on invested capital, this is what drives long-term shareholder returns in a lot of ways. And if you read a book, I think it's um, oh no,
Probably Howard Marks.
no, it's not Howard Marks. It's the book that I think it's 100 to 1. Yeah,
Okay.
100 to 1. That one talks about companies have returned 100 times over the long periods of time when the individual wrote the book did the study. It was a lot to do with companies that had high returns on invested capital because this is a measure of the company's ability to take the cash and then compound it. So they're
Okay.
compounding it at a rate of 58.4%, which is amazing. So in that case, this is actually a measure that people, okay, I'm gonna actually do a little bit of a knowledge drop here. And this is really important, Austin. I don't think we've discussed this.
I'm
Or
gonna
we've
make
had the
sure that I
chance to
write this
discuss
down.
it.
In case you didn't know, I've been taking notes and asking questions. So
So if you have a business that has a very high ROIC, you do not want them to pay it out as a dividend. You do not want them to pay it out as a dividend. Okay. So why
and
is that?
why is that? Because that defies all common logic. Why
Well,
is that?
it won't after I explain what ROIC is. So
Please do explain it.
ROIC, and in some ways also return on equity, but ROIC is measuring the company's ability to compound on money if they keep it. Now ask yourself, Austin, what is your confidence that you will compound your portfolio at 58.4%?
um
Likely, not
Hmm.
likely.
Mm, I'm probably going to plead the fifth in this one.
Okay, so well, if you're able to compound at 58.4%, that is actually better than what Warren Buffett claims he can do with $1 million. He claims that with $1 million, he can compound at 50% per year, right? And I believe him, but I'm saying like that's the level of skill. So 58.4% is pretty ridiculous, and there are a lot of companies that have done this or better than this, and over time they've generated tremendous amounts of return. So if a company has a high ROIC, and by the way, I know this is a snapshot, so we want to make sure it kind of sustains in that realm. But basically, you want to try to make sure that the ROIC is higher than what you could otherwise do. That's a good smell test of management's ability to manage the capital. If the ROIC is lower than what you think you can do, then you actually want the company to actually give that out as a dividend. That's how you kind of tell. So if the ROIC is low, then you say, please give me my capital. I can do better with it. If the ROIC is high, you do not want them. You want them to pay less of a dividend. You actually want them to keep more cash. Please compound it more. So that's a good kind of like a grade book, because I see a lot of people say, oh, I don't like dividends. They should keep my money and compound it more. It's like, well, what if their ROIC is like 4%, dude?
Yeah.
And
What if they stink at compounding it? Then they're just,
yeah, there's
it's
and
just
here's
literally eviscerating capital that could have just been returned to
yeah.
you,
And I've talked
you know?
about this. So like it's not that buybacks are good, dividends bad, or dividends good, buybacks bad. It's again very nuanced. Everyone loves to pick sides. Everyone really likes
Well,
to pick sides.
everybody loves structure because human beings, by their very nature, crave structure.
Yeah.
And investing is one of those things that like you pretty much have to take that box that you're thinking in. Once you know, like you've kind of like
Right.
learned the basics of accounting and learned the basics of finance, you got to take that box and you got to shred that
Exactly.
box and throw it away, and then
Yeah.
you just got to be fluid and think with fluidity. Now I have two questions. The
Yeah.
first one is that the return on invested capital, is there a way, let's say, I'm not accusing Dropbox of anything, but let's say that management had nefarious intentions. What would be some ways that they could influence this nefariously? And then how could a shareholder tell this? And then my second question is that Drew Houston, I think, is pledged to have 1 billion in free cash flow by 2024. Is that, I would assume it is, but is that playing into the ROIC number here that we're seeing right
No,
now?
no, because that's projections. And no, and I think the model I actually programmed it to use cash flow. So it's actually very difficult for them to manipulate unless they're just
Okay.
lying about numbers. So
Okay.
again, in a gap net income, yes, you can, if depending on again how you measure it. When you learn these ratios, by the way, in your class or school, then hopefully you also learn, if you have a nice professor, they'll teach you that uh, then you want to go out there and kind of develop your own ratios, because there is no definitive science to ratios. Like, okay, there's the basic ratios, like, okay, what is PE? Because P is very specific. However, depending on what return metric, so like I call them the grade book ratios. The grade book ratios, you can start to get creative with them. And
Yeah.
I mean, you got to be careful when you get creative with them, but you can, and you can customize them to what you believe you think is more important, because that's what the ratios are there for at the end of the day. They're there for you to observe and say, okay, I like that. I don't like that. I'm looking for something that's like this, but not like this. So that's what they're for. They're not, it's not a science. It can be kind of vocabulary intensive, for example, like again saying, what is PE? Well, PE is specifically the price divided by earnings. So you don't really change that. Earnings is very specific to GAAP earnings, but price to free
Yeah.
cash flow, right? Okay, so what are you going to include in the cash flows? And then, there you need some, accounting knowledge. But uh, sometimes you might say, well, I want to divide this by the cash flows, not by the net income. Okay, good for you. Do that, stuff like that. That's what I'm talking about.
Mhm.
Um,
All right. So now, kind of moving to the key ratios, I just want to kind of take a look at that just for a quick second. Now that you've wonderfully answered all of my questions there, but so
focus on these.
off of a preliminary look, what catches your eye the most about any of these ratios? Like, which ones do you like the
Debt.
most? And then which ones are you seeing here that you don't like the most?
Very good liquidity ratios, actually phenomenal liquidity ratios, stellar liquidity
Mhm.
ratios. I can't say anything better about that. And the solvency ratios, it's gotten worse over time. But here's the added context. They had no debt for a while, and then they just took on some debt to kind of have, because what's going on right now, Austin? What's going on right now in the macro environment?
A lot of economic uncertainty at the moment.
But what about interest rates? Are they high or low right now?
They're low, very low.
Extremely low. So
yeah,
when they're extremely low like this, it may be beneficial to take on that debt depending on the rates you get. And so they issued a ton of debt on convertible notes, and the conversion of the notes are at share prices. I don't know off the top of my head, but I think it's either in the $40 range or in the high 30s.
Mm-hmm.
And so that means that when the stock price gets to those levels, they can issue shares to pay that debt off instead of paying it in cash. But here's the thing.
So
the dilution would happen at a much higher share price.
Okay. So then my question here is, if the dilution's happening at a much higher share price, is that beneficial for shareholders in this instance, or would it not be beneficial? It would be beneficial. And why would it be beneficial here then?
So because basically they can pay it off, right? So, okay, so let me give you an example. Let's say the share price is $20 right now. Well, to pay off let's use $100, for example. If I want to pay you $100, I owe you $100, and I have to use shares to pay that off. All right. I can use shares. I have the option to. So one thing I can do is I can give you 5 shares right now, and now you have your $100. But let's say my share price goes up to 40, right? How many shares do I have to give you? I have to give you 2.5. See how it reduced? I reduced it by half. Okay.
Oh, now I'm getting, so, okay. So as the price goes up and this debt gets converted, it's less shares than if they were to go out on the market today at current prices. It'd be more shares. So it would be diluting shareholders more if they were to go out now rather than when they reach the stipulated prices, which is the higher price range, and they convert, then that's less shares.
And there's a context as to why that matters. Why that matters is when they issued the debt. They issued the debt when the share price was substantially lower than $40. So someone might be asking, like, why does that matter? It's because of when they issued the debt. They issued the debt when the share price was lower, much lower than $40. And now it's basically like a confidence, like, oh, we are confident that the share price will reach this. And so are the debt collectors. Otherwise, they wouldn't really have made that kind of deal. And again, they could be paid off in cash or through the debt conversion. And probably the debt conversion will be more favorable so that the company can just keep on the cash to invest in the business. And if the share prices get that high, I don't think investors will complain.
No, likely not. All right. Now, what are some ratios that you're seeing here that might concern you a little bit, other than the solvency ratios, which I don't even think those concern you all that much?
No, it's still not at unhealthy levels. So the gross profit margin is fantastic. Again, the net profit margin is negative, but I don't care because it's not actually indicative of the actual performance of the business. The cash flow is.
Okay.
So the ROA, ROE, ROA is obviously going to be negative. Return on equity is going to be positive because I think I'm measuring that one on a actually,
oh boy,
no,
that is an interesting earnings quality there, man.
Yeah, it's actually better. Remember,
it is.
earnings quality is below. It's an absolute value, so it's when it's below 1 or -1, and that's kind of unique to our channel. I made earnings quality as a measure to kind of grade the management, and how you can read that is in absolute terms. What does absolute mean? So -5, convert that to +5.
Yep, it's just an absolute number. So so basically what I'm looking at here is I'm seeing a story that's telling me we're starting off at about 3, we move down to below 1 in 18, and then 19 goes to 10 to 5. Okay, so we're seeing like pretty decent earnings quality, which would suggest to me that management is executing on its duties quite well in this instance.
Yes,
its obligations to shareholders.
Book value per share, again, we don't care about that. That makes no sense.
Yeah.
And I'm not going to go over activity ratios because there's no inventory. This is software.
Yeah. All right. So now taking it back to the actual model itself, why did you decide to choose these growth rates? And do you think that Dropbox is capable of achieving these, maybe more or maybe even less than this?
So I think Dropbox is, so it's averaged out about 20% in the past 5 years. But I think the midpoint, I think going forward, they can achieve is about 12%. I think it could be lower. Right now, I've told the model that I'm going to give each of these weightings an even amount. Okay, so I'm going to weight all these scenarios evenly, and it's telling me that based on the risk profile and my required rate of return, I can safely allocate 6.59% of my portfolio into Dropbox. And I believe it's actually close to that. It's a little bit less, but it's close to that. It was allocated less than that, but it's grown into the current allocation percentage. And I'll show everyone actually right now what my
20.
discount rate
Yeah,
was.
I was about to ask for 20%.
So
So
remember
it's
what,
almost right there. Yeah, it's almost right there.
well, what
You
price
know?
did I buy it at? That's because I own it at 82, 84, 82. It's within that range.
Mhm.
So you can kind of see when I was modeling this out, which was a little bit back in the past last year, my model was telling me to buy it and I could assume less than a 10% growth rate. I believe at the time it was 8%. Let me actually plug in 8. Yeah, it was between 8 and 10%. It was somewhere around there. And I really thought that Dropbox could hit those numbers very conservatively.
Mhm.
Now, why am I assuming no share dilution? Well, they are doing buybacks, but I actually think the buybacks are going to be nullified. And that's actually the key. They're going to be nullified by the share dilution by employees. Okay, so employee compensation, stock-based compensation, I do think it will nullify the buybacks. But the company has said it is their goal to reduce share count. So if they actually do that, then my model is actually being too conservative, right? I'm being too
Yeah.
pessimistic because watch what happens. If I want to assume that we're going to, at the end of the 10 years, have less shares. Oh, I diluted it. But
Yeah.
this is what it would look like if I diluted it.
Mhm.
I can still assume dilution and actually come out with a fairly reasonable price for myself where I bought at 17. I can assume around 10% growth rate and I'm going to come out okay with a very high discount rate. Okay, so mind you, that is a very high discount rate.
And
A lot
that's
can go
yeah,
wrong.
that's a serious margin of safety.
Yeah, a
That's like
lot can go
100%
wrong
over
in my
10%.
price.
Yeah.
Mhm. Exactly.
Yeah.
So if I, for example, assume a 1% buyback,
If I may cut in for a quick
cut in.
second too, I've seen some people believe that we are saying that we require 20% on this investment here. While that might be the case sometimes, in this specific instance, at least for me, I would require 10%, and I'm adding a 100% margin of safety through the discount rate onto that required rate of return of 10%.
Yeah,
Yeah,
tomato
basically.
because
Yeah,
it's two ways of saying the same thing because when you're
it is.
discounting higher, like I said almost at the beginning of the video for the model, uh, increasing this discount rate simply implies margin of safety. You can
Mhm.
apply a margin of safety in different ways. It's just math at the end of the day. You can lower your growth rates, or you can increase your margin of safety through the discount rate.
Yeah.
Or at the end of well, actually, I think that's more of the terminal multiple approach, which in that case, you can just expand or decline the multiple at the end.
Yeah.
But anyway, the point here is if I can assume a 1% buyback, if I think they can achieve that, I can assume a 12% growth rate, which is actually the middle assumption, and they actually could achieve 20% rates of return per year. Okay, I know the model is telling me based on the risk, I should only allocate 0.94%, but that's me weighting it correctly. I actually don't think 8% is probable. Well, not probable. I think it is probable, but I don't think it should be weighted the same. And I also don't think 20% should be weighted the same. But right now
Mhm.
they're all weighted evenly. So mind you on that. And
Okay.
we want to point out that analysts have a price target of
Yeah,
$34.40.
I was about to ask in this instance, are the analysts cringe, as we like to say, or are they
Well,
is
there's
there some basis to what they're saying here?
there's so many analysts out there. Some are right, some are wrong. So I won't, broaden the term for all analysts, but sometimes analysts
Are
can get
cringe.
they can be a little cringe. But
Yeah.
Sometimes a lot of them are,
Come on, man. Say it.
I'm diplomatic. I'm the diplomatic one.
Yes.
But they can be spot on in some instances because it's a judgment on an individual basis. And I think for Dropbox, they're onto something.
Mhm.
So we will see next time or next year how everything pans out. Something I have been doing is I've been selling some calls on Dropbox and then taking those premiums and then reinvesting them. So in that way, Dropbox has actually been giving me dividends in an indirect way. It's not literally dividends, but it's options premiums. And I've been selling out of the money call options into the future, but not too far into the future. I think I have some expiring December, I think next Friday, and made some decent amount. If you analyze the returns on just the options premiums, it's pretty good. It's nothing to shy or to sniff out about. But yeah, that's pretty much it. So Austin, I have to ask you,
Yes.
after all that we've talked about, and along with the audience out there, you can comment down below what you've ended up deciding. Remember, just because I'm invested in Dropbox doesn't mean that you should. And remember that I'm in at a different price. I'm in at
Yeah.
1780 something. So my required rate of return, my discount rate, everything is a little bit different. But if you had to add to Dropbox, are you actually interested? Because I still think today it's presenting a decent opportunity.
I'm definitely, after everything that I've learned about the business. Hold on, keep it at 20 for just a quick second.
No, 35.
You want to go to 35?
I'm
Going
kidding.
back to 20. So yeah, after everything that I've learned today, I'm definitely interested. I'm going to do a little bit more research into the competitors. That's something that I need to understand. And then I need to understand sort of like the 3D chess game that Drew Houston is going to kind of mitigate some of these competitors just really encroaching on the business. But
Mhm.
in the meanwhile, if the stock goes to $21, I will open a position in Dropbox. If it
Mhm.
goes to $21, I will open a position in
Okay,
Dropbox.
but what's your strategy going forward if it doesn't? Are you just
If
going to
it
say if it
doesn't,
does not? So basically you have before your decision. Are you
yeah.
going to add even if it doesn't go to 20? Because what I like to do, and this is again for the audience and for you, what I like to do is I'll set up a range of prices. That's why, for example, in this model, I created 5 separate scenarios. I don't like to stick it all into one price.
Yeah, I would probably actually say in this instance, from where Dropbox is right now, after I've done my significant amount of research, I would probably, if I'm being honest, I'd probably nibble at these prices a little bit. But if
There you
it
go.
were to go
Strategy.
to around $21 and that legitimately satisfies, as you know, I say this all the time, every single video, it satisfies my assumptions, but it legitimately does. If I can assume a 20% required rate of return with a 1% buyback and a 10% growth in cash flows over the next 10 years,
I don't want to
then I
consume the
will,
buyback. The buyback's
yeah,
icing on the cake.
then I would probably actually open a pretty sizable position if it were to go to $21. Right now, I'm going to keep doing more research, but if the price were to stay at the range that it is now and or to even go up, I would probably start to nibble or start a small position there.
Mind
Because
you, I could be
yes.
very conservative because at any point, the other projects that Drew Houston has going on could accelerate the growth. I'm being fairly conservative with the growth rates
Mhm.
because I gave a medium growth rate of 12%, medium. And
Yeah.
again, 20% is the high end, like the super high end. And that's what they've averaged, right? And then I'm also giving an equal weighting, right? At the same amount of weighting to an 8% growth rate, which is lower than they've ever done, right? So that's being implied. And this is where this is again, like Austin's pointing out, pricing or when you enter is very important because that actually dictates your risk. So for example, my buy price is very close to the assumption of 8% growth rate, right? 8% growth rate. And I'm assuming the buybacks are, at just the very least neutral because they're going to dilute me enough to nullify the buybacks, which is unfortunate. So the share counts won't actually matter at the end. And because if they are able to do something about the share count and bring it down a bit, Then, as I've said, I'm just assuming a 1%. Then I'm in home free, because now I can assume even lower growth rates for me to achieve 20%, because I'm below the 1888. But for Austin here, I would say, set up ranges for your nibble, your bite, and then your gulp. And then that's kind of how I would approach it. But then again, I could just be stupid.
No, I mean, like it's good advice, and I'll definitely keep that into account too. Do you have any closing thoughts before I wrap up the show here today?
No, that's pretty much it.
All right. Well, we hope that you guys have enjoyed this latest episode of the Capital Mindset Show. We are your hosts, Austin and Fabio. If you have, please be sure to share the video. It really, really helps out our channel. Please be sure to visit our website, capitalmindset.org, and comment any suggestions or critiques or questions even in the comment section below. And do please subscribe, and we'll see you guys later. Take care.